Tesla just reported what I thought was an excellent quarter given the macroeconomic environment it finds itself in. But despite those positive results, the stock price sold off more than 12%. That was curious. I want to dig deeper and understand what's going on with Tesla stock. So follow along and let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so Tesla CEO Elon Musk said in the quarterly conference call that followed its earnings release that they saw a large adoption and acceleration of EVs and then a bit of a hangover as others struggled to make compelling electric vehicles. So there have been quite a few competing electric vehicles that have entered the market, and mostly they have not done well. But they have discounted their EVs quite substantially, which has made it a bit difficult for Tesla. Indeed. So over the last several years, especially following the frenzy in 2020, there's been several new EV models and several new EV companies. And that's because during the 2020 investing frenzy, EV companies got injected with billions and billions of dollars of capital. Now, during most times, they would not have been able to raise that kind of capital for that kind of company. But because of the unique investing environment in 2020 and 2021, new electric vehicle companies that just showed a picture of an electric vehicle to investors were able to raise money to start their company. And it wasn't an environment of investors being picky or cautious with investments. It was a period of investors just trying to throw their money at anything related to electric vehicles. And so you had several new companies, several new electric vehicle companies come on the scene that probably should have never been able to do so. And so you've had this oversupply of electric vehicles, and Elon Musk is right in that most of them have not done well. The most recent casualty being Fisker Automotive. Now, they are still trying to sell some of those models that they created, and they're now on the verge of going out of business, but they've discounted their existing models so substantially to try and sell them and fulfill their debts. And that's hurting Tesla because all of this extra supply on the market gives consumers more options and lower priced options compared to Tesla. Now, this shakeout will take some time because of the factor I mentioned earlier. These EV companies were injected with billions and billions of dollars, and some, in the case of Rivian, got injected with almost $20 billion. And so even though they've worked down a lot of that capital, they're still vying for EV market share because they're still around and they've got more investment now from VW, and they're still producing tens of thousands of units, and they're still going to be around for some time. Now, their difficulties have caused them to slow down their production expansion, which is good news for Tesla, right? You heard Rivian say that they're pausing production expansion in their Georgia facility. Fisker's going out of business, so they're not producing. You've heard companies like Ford and GM and others say that they're reducing the expansion of their electric vehicle lineups. So the EV industry is coming into better alignment, although it will take more time to come into balance because of how much capital the industry received during the pandemic frenzy. Tesla also said that they're investing in many future projects, including artificial intelligence training and inference, and a great deal of infrastructure to support future products. And that's really good news for Tesla stock investors because at this point, Tesla's valuation is dependent on the future. Tesla, as it currently stands, with just its electric vehicle business, is not going to command the kind of valuation that Tesla currently commands. It's trading at a forward price to earnings of over 60, where rival automakers like Ford and GM are trading at a forward price to earnings of 1/10 that valuation. They're trading at a forward PE of 6 or 7 when Tesla is at 60. And the reason investors are willing to pay a forward PE valuation of 60 for Tesla is because of these future projects. artificial intelligence, the Optimus robot, the robo-taxi. Without that, Tesla's valuation would fall by 90%. And so the company needs to just continue investing in this category, even if the results are not great, because the valuation of the stock will remain elevated as long as the company continues making progress, continues giving investors updates, and continues convincing investors that they're eventually going to reach this goal, right? So they've put themselves in a position where they just need to keep going forward in this regard, and they can't back out of it because it's going to cost the company a significant valuation reduction if they were to pull back on these investments. So they just have to move forward, and it's been slow going. Tesla told investors that they would have driverless car technology 7 years ago, 8 years ago, and they've still not got it. They still have this, supervised full self-driving. So it is progress, but that progress is much slower than Tesla has been telling investors. And so they've put themselves in a position to continue having to do this, but they've also found a way to enhance the valuation of the company by convincing investors that they will achieve this goal. So they have investors convinced, and that's reflected in its valuation. If investors were not convinced and the market was not convinced, Tesla stock would not be trading at a forward PE of 60. It would be trading at a forward PE in the single digits. So investors, the market is convinced. Most of the market is convinced. They're saying they are on track to deliver a more affordable model in the first half of next year. Remember, a few years ago, Tesla told investors that they were going to launch a lower priced $25,000 model. Since then, they've pulled back those ambitions, as they usually do, right? They make big promises and they give you like a fraction of what they promised. And they've said they're going to introduce a lower priced model in the first half of next year, but I don't think it's going to approach anywhere near $25,000. I think investors should be happy if it approaches $30,000. If Tesla can produce a model for $30,000, I think it would be great news for Tesla stock investors. But again, Tesla trying to take attention away from electric vehicles and saying that their biggest differentiator is autonomy. They want you to invest in Tesla because of autonomy, driverless cars, the robo-taxi, the Optimus robot. They don't want you to think of Tesla as an EV company, because if you think of Tesla as an EV company, that would mean that it gets a valuation in the single digits, a forward PE of 6 or 7, which would mean the stock price falls by 80 or 90%. Tesla doesn't want that. It wants you to think of it as a robotics company, an artificial intelligence company, and therefore it can command higher valuations. So as you'll see in this quarterly conference call, and with many quarterly conference call in almost any time Tesla management discusses the company with investors, they focus the discussion on those parts of the business, and they distract away from electric vehicle sales. So for investors, for shareholders, they're doing a good job keeping the valuation of the company elevated and giving itself time to produce results in these innovative technologies. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.